Glad to have you here with us on The Retirement Key with Abe Abish, founder of Abish Financial Services. TheRetirementKey.com is where you can go to learn more about Abe and his team and the ways they can help you when it comes to your financial future, the second phase of your financial life, as Abe likes to call it, thinking about your retirement years. And when it comes to retirement and our wealth, it is protection that we are looking for. A new survey from the Global Atlantic Financial Group talked to people between the ages of 55 to 75. And over half, 60% of respondents say they want to protect their existing savings over seeking growth on their wealth. It makes sense. We have worked so hard to earn and save. Now we're here. We got to make this money now work for us, Abe.
Right.
Is this a common mindset of clients that you work with? Is that
it is?
Commonality?
It is, Heather. Yeah, it's very common of almost all of our clients. And think about it this way. You know, if you were 65 and you and your husband were retiring this year, and you've just worked the last 40 years, right? Maybe longer, 40 something years to get to 65, to get to the place where you have, maybe it's 3 million or 5 million. I don't know what your personal goal is, but let's say it's 5 and you hit 5 million and you're 65. And you need and want 5 million to do the things you and your husband want to do in retirement, then naturally you'd probably be a little concerned about what could happen to the 5 million if you're not prepared to protect against it.
Yeah.
Now, what are the big risks that can mess up that 5 million, that can cause you to lose some or all of that 5 million over a lifetime? Well, you've got stock market risk. We need to deal with that. You've got sequence risk. That's your drawdown risk as you're taking money out of your portfolio. You've got all kinds of risks, not enough time to go through it today. Tax risk, inflation risk, healthcare risk, and all kinds of things. But today, on today's podcast, we'll probably talk about stock market risk and then how to protect your nest egg against it when you're really close to retirement or there. So you've worked your entire life to get here. Naturally, you're going to be thinking, well, what if the markets go down 20, 30, 40? How would that affect me? How would my portfolio stand up against that? Would I lose as much as I would, 20 years ago in my 40s because I'm taking on too much risk? And so those are natural thoughts for most people that we help, most people that meet with us to come check us out is, all right, I'm here. I'm happy that I got my 5 million or whatever the amount is, but I also want to make sure I can sleep at night and I don't take massive loss in a bad year or a bad series of years.
Right. There are so many things that we have to factor in. Longevity, probably one of the biggest risks as well. Thinking about, you work for 40 years, but some people are retired for 40 years. We're living longer and longer. Yep. So let's talk about how we then balance risk, but also still factoring in some growth, because with longevity, we do need to leave space for growth.
You do. I mean, you could be 65 and live 30 years or longer, right? Or 25, 30, 35 years. So that's a long time. That's a long time to get your money to last. I mean, you haven't done this before. You just worked for 40 years with wages and a consistent paycheck that you depended on to pay all the bills and to save. Now that consistent paycheck is gone. It's ended. You've chosen to end it most of the time. I mean, some people get laid off, but most people choose when they want to retire. You've chosen to end that consistent paycheck. Now you have to create consistent paychecks and stability throughout retirement you can depend on. You do need growth, right? So if you're too safe, and you think about safe financial instruments, we'll talk about that in a few minutes.
Okay.
If you're too safe and you only end up making 3, 4, 5% over your life, well, you're barely keeping up with inflation. So some people say, well, if I hit my number, why don't I just move it all to something really safe like a treasury?
Yeah.
And then some people say, well, I like my 5 million and I like the returns I'm getting, 10, 15, 20% returns. I don't want to lose that either. It's a combination of the two that most people need.
Okay.
So a classic combination between growth and safety, risk and safety, growth and income, is a 60-40, right? It's just north and middle of the road, Heather. And that would mean, like, if you had $1 million, for us at Abish Financial, 60% of the million would be invested in growth-focused instruments. What are those? Common stocks, right? Stocks are common, ETFs and things like that. Now, as you get safer and move over to the other 40%, there are a lot of instruments that you can implement in a retirement plan to implement more protection, more safety. I mean, you think of the common things that we're going to have in our portfolios too are some treasuries, right? Government treasuries currently, as of this recording, that are paying more than 4%. So that's not too bad.
Okay.
Keeping up with inflation, backed by the U.S. government. 4.5% kind of in that range. CDs could be an option. Not the biggest fan of CDs right now. At the time of this recording, they're paying around 4. Money markets paying 4.5 right now. Certain types of annuities, principal protected annuities, the one without fees and bells and whistles, can make somewhere between 4 and 6. Structured notes can have total protection built in. Structured notes, certain kinds of them can also have buffering built in. Really unique. What buffering means is, if the markets fell from 0 down to negative 20%, that the client may not or would not suffer a loss until or unless the markets fell below negative 20%.
Okay.
So if you think about principal protected investments, principal protected instruments, let's just say cash, treasuries, money markets, CDs, fixed rate annuities or fixed index annuities. Those 4, 5, 6 instruments can't go down when the markets go down, right? They're generally safe and principal protected. Well, what are you giving up in exchange for the safety? You're giving up some return. And sometimes a lot of return. You're probably talking about across those instruments right now, again, maybe 4 or 5% either growth potential or even guarantees right now at the time of this recording. Okay. Then as you move up the chart with us at Abish, if you're talking about building the foundation of the plan with the safest stuff in there, then the next chunk of investments might be those types, like I was just mentioning, the structured notes, which are buffered. We'll use buffered structured notes in there. A structured note is a bank product.
Okay.
If you invest with a bank, you want it to be with a big time bank. So we use some of the biggest out there. Personally, we use JP Morgan and Goldman Sachs and Bank of America and some of the big dogs out there. Because if your money's with the bank, you want it to be safe.
Yeah.
And so those buffered structured notes, sometimes even dual directional, can make money not only when the markets are up, but also when they're down. It's really interesting. And they'll oftentimes have this negative 20% buffer so that you can only lose money in the instrument if one of the major indexes, usually the S&P, Russell, or NASDAQ, fell below negative 20. Well, again, that gives us a good bit of safety built in there. Not 100% total downside protection, but a good bit of buffering and leverage, if you will. And then as we move back up to the 60%, and you look at what might be the common growth focused investments that we would use or that someone would use in retirement, you're talking about stocks, ETFs, maybe mutual funds. You can sprinkle in some things like alternatives, real estate funds, and even some crypto funds or something like that, gold, precious metals. But those are kind of the common pieces to a retirement plan. A lot of people just use stocks and bonds out there. A lot of the phase one firms will keep it really simple and just use stocks and bonds, maybe a little bit of alternatives. But I think you got to get, a little creative as you get close to retirement. And in retirement, use sometimes some outside of the box instruments that you may not have used in phase one that could be really appropriate for you in phase two as all that wage ends. And you really need to make sure this money lasts you for the rest of your life.
Thinking about phase two, if you've got questions, theretirementkey.com is where to start this conversations with Abe and his team, because as you were just pointing out, and a conversation we've had previously is how this is not our grandparents' retirement. Meanwhile, is it 10,000 people every single day turning 65 right now?
For the next 7 to 10 years in a row. Yep.
I feel like so many of us, hardworking, educated Americans, we open the door to figuring out our financial future. And it's like, have you ever opened up a closet? It's maybe your grandparents' house and all this stuff comes tumbling out at you. Yeah. And you're like, no, you quickly go to shut the door back shut because you're like,
you don't even know where to start.
Options, you don't know where to start.
It can be overwhelming.
There's so much out there now.
Yeah.
It's almost like, with all this stuff on Netflix and Hulu, you can't find anything to watch because there's so much to choose from. It's like you get overwhelmed and you just turn the TV off. That's how it feels.
I think at the end of the day, Heather, you really need to find someone and a firm that you trust.
Yeah.
Well, how can you get to that point of trust?
Yeah.
You meet with them, you find out if you believe and think that the plans and the recommendations that this advisor firm is making make sense. Do they make sense to you? Does it appear that the plan is going to help you to meet your needs? Mm-hmm. Do you like the people that you could potentially work with, and do you trust them?
What you got to tell you? Yeah.
Yeah, it typically doesn't take long to size somebody up. I mean, oftentimes what they say, an impression's made in the first 5 seconds
Mhm.
of meeting somebody. You know, one of our core values here at Abish is to communicate, with transparency and honesty. What you see is what you get here. We're real, genuine, good people that want to do the right thing for our clients, that want
Yeah.
to do as best as we possibly can for our clients. So that's up to you to decide. But I think
Yeah.
all that's really important. The products and investments, the plan is really important. But at the end of the day, you need to like your advisor. You need to like your financial professional that you're working with, and also really be able to trust them.
Yep. Working to help you understand the options, because another thing that you always point out is you don't like giving blanket advice. So to you
Right.
listening to this podcast or watching this video on YouTube, lots of obviously things for you to investigate that Abe was pointing out, things like structured notes and CDs
Sure.
and annuities and working
Sure.
to create less risk in your savings plan. But what would work for you exactly? We don't know unless we sit down and have this conversation with you specifically.
Every
So
plan is
again,
different.
that's right. TheRetirementKey.com. If you want to learn more about Abish Financial Services and get to know Abe and his team, find us there at TheRetirementKey.com or click on the links we got posted in the show notes. Also in the show notes, you can see links as far as your book goes. The Retirement Mountain, the 7 Steps to a Long-Lasting Retirement. A quick read. I think it's just about a little over 100 pages. You can probably read it in just a few hours on the weekend. But Abe, one of them in the 7 steps, step 4, chapter 14
Right.
is just that, protect your life
Yeah.
savings, because you always point out how so much risk in retirement is that descent down the mountain. You've worked so hard working your way to the top, earning and saving, but the slip ups, the mistakes that can happen on the other side coming down that mountain are what can really mess up your retirement.
Yeah, look at the little quote at the top of this
Yeah.
book, right?
Yeah.
The
Yeah.
greatest risk in retirement is not the ascent, but the descent.
Yep.
80% of mountain climbing accidents, 80% of mountain climbing accidents happen on the descent.
Yep.
They've already reached the peak, right? In other words,
Yep.
you've already hit your peak of what you're going to have accumulated by the time you retire. Don't mess it up.
Yeah.
You're at the goal line. You're about ready to score and win. Seal the deal. Lock in all the gains, clip in as much as you can, take as much risk off the table as you can while still satisfying the growth side. Have a combination, have a written, thorough, comprehensive, detailed retirement plan that you follow several times a year with someone who specializes in this phase of retirement.
Specializes, is an independent. Abe and his team, they are not answering to the people upstairs. As an independent financial and fiduciary retirement planner, they are here to help you with all of these things, help you on that descent, help you to have what's hopefully going to be a very happy and healthy retirement. So again, it's theretirementkey.com, or you can just click on the links we got posted on the show notes. Let's help you get started.